The new Indian budget of 2024 brings an interesting aspect towards the bond market. In this video, we'll talk about its impact in details. If you like content like this, please feel free to subscribe to WealthAbhi. The finance minister indicated in this budget that the 2023 fiscal deficit was 5.8%. As per the previous estimate, this fiscal deficit was expected to be 5.9%. The government indicated that they were successful in reducing the fiscal deficit for 2023 marginally. However, this is the last year's estimate and the budget is for the next year. In the new budget, the finance minister indicated that the government will reduce the fiscal budget to 5.1% in the upcoming financial year. This 5.1% estimate is better than what the market was expecting. The market was expecting a fiscal deficit of 5.4%. So, it means that the government borrowings will come down in the coming years. This brings a very good indication for the bond market. Let's understand how this impacts the bond market. Generally, the government borrowings increase when the fiscal deficit goes up. This is how the government manages the fiscal deficit. Lower fiscal deficit means that the government borrowings will reduce. If the government's borrowings reduce, then the yield of the GSEC, which is government securities, goes down. Now, the question is, how does it benefit the bond investors? If the interest rate on the bonds goes down, then the yield of the existing bonds goes up. It means if you're a bond investor and you've already invested in bond mutual funds, then the net asset value or NAV of those mutual funds increases. This increase in NAV is because of higher yield of the existing bonds. But remember, this increase in NAV is not for all bond mutual funds. Generally, the liquid fund or the very short-term bond funds might not get impacted much. However, the GILT funds, as well as the long-term or medium-term bond funds or target maturity funds, will be positively impacted by it. That is because of the existing funds which are already holding a long-term bond of higher yield. The NAV of those bonds will go up higher. Similarly, the GILT funds invest in GSEC. As the interest rate reduces for the present GSEC, the value of existing bonds go up. That was already indicated as the bond market rallied by 1 to 2% increase in its NAV. Now, the bond market was expecting interest rate reversal from probably the end of the year. However, with this budget announcement, it looks like the party has already started. You can expect the interest rate reversal probably by the end of the year. So, it looks like this is the right time to invest in gilt funds or long or medium term bond funds. If you like this video, please don't forget to like it and subscribe to our channel. Also, press the bell icon to be notified of our future uploads.